And here we go. Hi, and welcome to From the Research Chair. This is episode 13. I am Jason Voss, and that is...
Michael Falk, lucky number 13 today.
I'm a Friday the 13th birthday originally, so I like it. We have a special episode this week doing something we've not done before. We have a guest, and it's somebody that Michael and I really respect.
Wait, we always have guests, people who watch the podcast.
As a guest star, maybe? Guest co-host?
I think that's better.
Now you're embarrassing me.
Yes. So his name is Joachim Klement, and he's an investment strategist. And I haven't heard, is it Liberum? I haven't heard you pronounce it out loud.
It's Liberum.
Liberum. Okay. So Liberum Capital, author of Geopolitics monograph that just came out, which is going to be our first subject of the day, as well as an excellent book that I think, Michael, you and I both served as reviewers on, if I'm not mistaken, called 7 Mistakes Every Investor Makes, which is insightful. And I think each of you are going to find JK, as I like to call him, fun, insightful, varied, and different. And I can't say that about too many folks. In fact, JK's daily newsletter is the only one I read in the investment business. Michael, say a few kind words about our friend here.
I look forward to receiving the daily email with his writing. Now, those who've heard me speak on this podcast for 12 episodes already, my God, you're patient with me. All right, listen. You have an idea of what I read and what I know. I look forward to that email every morning. Witty, interesting, timely. And that doesn't even get into his other work. That's just a daily little blog. I'm honored to call him a friend, and I'm just so happy we have him today.
Well, so let's let him speak for himself. JK, talk to us about geopolitics. You and I have discussed this before on the sidelines of various events that we've been at. Why don't investors pay attention to geopolitics? Do you have any thoughts on that?
Well, first of all, let me thank you for your kind words. And that was by far the kindest and most recent introduction that I've ever had. I try to not lower the high standard of your first 12 episodes. So please give me some slack. I'll try to do my best. And when it comes to that geopolitics book, I started writing that in 2019, summer 2019. And because of my frustration, because I am a politics junkie. I love to read about politics. I love to follow politics. Not just your mainstream, what goes on in Washington and maybe what goes on in London because I live in London, and what goes on maybe in Berlin because I'm German. But also crazy stuff that goes on in the Hindu Kush or wherever it is, And because I'm a politics junkie, I also follow a lot of those political scientists, political analysts that kind of pander their wares, so to say, to investors in order to help them make sense of the world. And my continuous frustration with them was that these are all really good political scientists, but they have no clue about investing. So they will talk your ears off about Afghanistan and the insurrection in Iraq, and you look at it in your daily markets or in your investment portfolio, and there's absolutely zero impact of that. Yes, super important politically. Yes, a tragedy from a human perspective, but from a hard-nosed investor perspective, a total non-event. And I think I started that, as I said, 2019 because of that frustration. I wanted to bring the perspective of an economist investor who's done that for the last more years than I can actually count. I was thinking, like, how can I explain political events to investors and what matters and what doesn't matter to them. And that's kind of how I wrote that book. And ironically, or rather sadly, it is the 7th of January. And yesterday it became again very, very important and timely.
So would you say that the reason investors don't pay attention is because usually the sort of analyses are done that are done are a little tone deaf relative to investment, or is there something else underlying that?
I think my main thesis is that they're not tone deaf at all, and investors aren't stupid or ignorant or neglecting political events in their investment assessment. No, not of that. The problem is that if you look at how assets are valued, we all know about discounted cash flow models. I'm sorry to bring that up and bring up traumatic memories from your university or whatever days. But if you look at discounted cash flows, they're a function of future cash flows discounted with expected inflation, real interest rates, and the risk premium. Done. So the question is, does a geopolitical event X influence either one of these variables, and in what way? And an insurrection in Iraq, unfortunately, at best triggers an increase in the risk premium for a couple of days. That's about it. But it doesn't change my fair value of my assets significantly, and especially not for a long-term oriented investor.
Michael, you want to say something?
I'm a simple guy, so I like simple questions.
I know you long enough to know that.
If we were to give percentages, what percent of the brilliant geopolitical monograph is a rant? What percentage of it is educational?
So the monograph has an introductory chapter, which is the rant. That's 5 pages or 10 pages. Then come the first.
You called it a chapter, so how many chapters are there?
There's an introduction and then 9 chapters.
So it's 10% rant.
It's less than 10% rant. I tried to keep it more to 5% rant. Then it's about 40% educational, where I review in 4 chapters what economists and political scientists have shown with empirical work. How do some political events influence markets, and where we actually have evidence that they don't influence markets. Classic example, terrorist attacks and most wars are irrelevant for the stock market and most other asset markets. And then the other 55% are chapters on geopolitical trends that I think will influence markets over the next 10 years in the 2020s. And we can talk about later about what these trends are.
Awesome. I love it. I gave you 2 choices and you took 3.
Well,
very nice.
He's a creative guy, just like us, of course. So, JK, how if you are a curious investor who falls into exactly the category you said, I care about political events, I care about geopolitical events, how would you begin to incorporate this? Is it easiest just to read a thoughtful strategist? Or are there some skills that I can pick up along the way that I can begin to incorporate into my work where I can take advantage of that? And that's maybe another way to answer that second part there is, what are some of the filters I should put in place as a news consumer that I can begin to sort signal from noise?
Okay, so first of all, you should just download that free ebook. After all, it's free. I'm not making a single dime on it. So
he's a mercenary, folks, not just an investment strategist.
Yeah, no, I'm just too good a person. So you should download that free book and read the first 4 chapters. There you will get basically.
We didn't put that in the introduction, that he's too good a person, Jason. Maybe we should have put that in the introduction today.
Too good a person.
Yeah.
Too good a person.
Yes, exactly. All right, so back to Joachim.
So start with that. Start with reading the first 4 chapters. Then I would say chapter 5 has my 10 rules of forecasting, which is literally 10 basic rules that I've developed in my career based on my investment diary of how to forecast and how not to forecast. So, and then think about basically, I would say, 2 variables. Variable number 1 is risk premium. Think if an event that you observe in the news, and usually the rule is it has to be some headline grabbing event. If you're like me, thinking about reading stuff about China in the South China Sea and the standoff with Singaporean battleships, that's good fun, but very unlikely to matter. But if it's a headline grabbing news item, like yesterday, for example, it will either influence the risk premium or inflation expectations. Those are the two most common cases. If you come to the conclusion that it only influences the risk premium, then every market setback is a buying opportunity, because that's going to be a short-term effect and it will sort itself out in due course, and you can just pick up some stocks or some corporate bonds or high-yield bonds at more attractive prices. If it has a long-term effect on inflation, either direct or indirect, we can then talk about it more definitely, then it's most likely going to be a long-term effect. And then you have to assess how will that impact my investments in the long run.
So talk to us.
Risk premium, Jason, risk premium sounds a lot like what long ago Mr. Rothschild talked about, buy when blood is running in the streets.
Absolutely.
Okay, so just we're clear on that. Then let's get to the longer term effects of either a change in inflation expectations or a change in interest rates, real interest rates, excuse me.
Yeah.
So we haven't answered the question. Oh, sorry. Did you
go ahead?
That? Yeah, I was going to ask you. We've talked about how to do it a little bit. You're a little bit of you were showing your teasing qualities more so than giving signal there. Talk to us about time horizon one, but then I'd love to hear from you the existential question. Why should I care? To be or not to be? Why are geopolitics important to follow?
Because while most political events are noise, some of them are really, really important and change your investment universe and your investment opportunities dramatically. To give you two concrete examples, free trade and globalization is the most powerful force in geopolitics that is beneficial for investors. Yet, I find it interesting that the RCEP, the Regional Comprehensive Economic Partnership, has been launched last year officially in November. It is the world's largest free trade zone in place now. Have you read a lot of these headlines? No, it's been completely ignored in the media, largely, even though it is a free trade zone, or on its way to a free trade zone from covering everything from China down to Australia, including Indonesia and all of Southeast Asia. And in a couple of years' time, it's highly likely that India will be part of it as well, at which point half of the world's population will be covered by that free trade zone. It will dramatically improve the growth prospects of countries like Thailand, Vietnam, China itself, Malaysia, Indonesia. So if you have companies or investments there that are exposed to the value chain in the sense of delivering to China or working with companies in China in some way or another, they will automatically get higher growth prospects in the next couple of years from that free trade argument. Nowhere discussed, even though it changes your investment opportunity set dramatically.
Is it fair to say, going back slightly to summarize your answer so far, geopolitics is important because it's one of the things that can shift the whole curve rather than be just a movement along the curve?
Absolutely. In one of the chapters in my book, I show the amount of systematic annual productivity growth that you could get by completely liberalizing trade across the world for developed countries. I'm not talking about, what can an underdeveloped country that has restricted trade gain, but countries like the UK or the US can gain about 0.5 percentage point of growth each year if we would live in a world of totally free trade.
And as a consequence, then, would it be fair to argue that Brexit bad, US nativism, I'm trying to use the nicer of the two words, bad. Simple as that?
It is as simple as that. The entire trend towards, I would say, inward-looking policies, whether it is Brexit or the US-China trade war, all of these policies permanently shift the growth rate for economic growth, and with that, obviously, for revenue growth of companies, down. The good news is that the US-China trade war, in its effect, is so small that it hasn't really damaged US economic growth or Chinese economic growth for that matter.
Yeah.
There we're talking 0.1 percentage points or something like that. Brexit, entirely different story. The UK probably, I've just done the analysis. We've lost over the last 4 years since the referendum to the Brexit actually happening about £3.5 billion sterling, so about $5 billion in investments in machinery and equipment alone. Total estimated loss will be, of Brexit alone, will be about 4% of UK GDP. So that's massive.
Indeed. So both Michael and I love geopolitics. I'm going to provide just a little commentary why it's factored into my research for a long time. It is one of the few things where past frequently is prologue, because the components that make up geopolitics are very difficult to change. Said another way, they have high inertia. They're one of the few things that actually lead to reliable predictions, in my opinion. And I'm also, and I've mentioned on the podcast before, a fan of scenario planning. And one of the steps in successful scenario planning is to identify predetermined elements. And geopolitics is one of the predetermined elements in almost every analysis I've ever sat down to do of this kind. And yet it's unappreciated, meaning it's mispriced frequently. And so that's a little bit of why I think it's important to pay attention to geopolitics and to educate yourself. In fact, when I was at CFA Institute as content director for members, one of the things I argued internally, ironically enough, that JK has been honored with the ability to write this monograph, is I said that there should be geopolitics content in the CFA program, and at least for members, there should be geopolitical resources for this very reason. Michael, I know you're a fan too.
Yeah, and I'm just gonna, yes, and. The end is real simple. Trade globally has just given more people around the world the ability to have a higher standard of living than anything else that has ever been attempted. All right, so that's just a fact. However, as we have populism rearing its ugly head in different parts of the world, not just my country, the problem that it has is it has the potential to reduce trade. Now, I think the supply chains are so robust, so deep, so big that good luck. However, this is the single thing that I am watching regularly, specifically because that change, if it reverses or slows down, has manifold impacts on investments and portfolios and global and everything.
Yes.
So
absolutely.
yes, and.
No, absolutely agreed. No matter how much of a social democrat I am in the European sense, please don't call me a socialist, because I'm not.
Different terms. They're different terms.
I am a capitalist, because capitalism and free trade and globalization are the best means that we've ever invented in 250,000 years of human evolution to reduce poverty, to create peace, and to create prosperity around the world.
And there's an urge for it anyway. I remember, because I have spent my fair share of time in coffeehouse Marxist discussions in my years. I actually have friends who call themselves Marxists, or I did. I think they've since grown up. Nonetheless, I would point out that in the former Soviet Union, that spontaneous markets arose even in the heart of socialism / communism, right? So famously, if you wanted Western jazz records, you would trade lots of Soviet toilet paper for them, and or if you wanted Western jeans so that you could be seen as an outlaw and a rebel within your culture, you would pay a heavy price. And these markets spontaneously arose. It's a trading what you have an excess of for something you have demand for is I think a natural human function that's oftentimes lost in these discussions. And if you believe that's true, that is the anchor, which basically says that capitalism, if done well, can unleash that natural tendency.
You know, it's also deeply underlying what you just said, the beauty of diversity. Trade, you have this, I have that. We need to exchange because we both appreciate what each other have. Oh my God, that's diversity, and it's beautiful, and it works.
Yeah, I wrote a piece and JK, I want to bring you in. I don't want to, this should be mostly your airtime, but I wrote a piece, probably my favorite piece I did for CFA Institute, called Capitalism. It's not just about competition, it's about cooperation. And markets are a cooperative. You both parties, the buyer and seller, have to agree to a price, but we tend to think of them as these, law of the jungle competitive things. And yet there's a cooperative element there that's lost in the philosophical discussion. With markets, you don't have to use force of arms. To JK's point about peace, bringing peace, because it's a cooperative and both people agree, absence coercion, that's a beautiful thing.
No, I completely agree with you. And my parents are both from Hungary. My dad was a Hungarian refugee in 1956, but I remember very well going with them to, back then, socialist, Marxist Hungary in the 1980s, where you had exactly that kind of black market for, in that case, Deutschmark and Western goods that you could trade for wine, meat, eggs, whatever. So that stuff was there, and people would naturally trade with each other. And when it comes to diversity, I mean, if I just imagine if we in the UK would now, after Brexit, have to rely only on the food that we can produce in the UK.
Uh-oh.
Oh, God.
You have to move. You gotta leave.
I mean, if that would be the case, I would be on the first flight or train to France, and that would be it.
The English are famous for their champagne. What are you talking about?
Well, that's actually one of the good things that we produce by now. We do have bubbly wine that is really good. But other than that, we just kind of got fishing rights for fish that we don't even eat. So, there you go.
So, Michael, do you think we should transition to 7 mistakes every investor makes from geopolitics? Or
I would love our friend to tell us the 7 silly things that we do over and over again.
Well, first, we don't buy his book. We should buy the book. All right. Anyway,
give us a tour. Give us a brief tour. How silly are we?
Well, we're all very silly. And to just kind of caveat the fact that I'm going to talk about the 7 mistakes that everybody makes, I'm guilty as charged with every single one of them. I have compiled those 7 mistakes based on basically a review of what I have done in the past and where I have paid, if you want to be generous, school fees as an investor. These are things like one of the most common things is overtrading, being too impatient or too noise driven and just kind of trading from left to right, from one asset to another, and in the process losing a lot of money and making my broker really happy. To less common things, I would say, like not learning from the past, which I think is a much underappreciated error. A lot of people continue to either consciously or subconsciously make the same mistake over and over again because they have no learning process in place when it comes to their investment process. They don't kind of review their past investments and then kind of go back to like, could I have done it better? What was the mistake that I made honestly there? And what I try to do for every one of these mistakes is not just show you how stupid you are. As I said, we all are stupid. We all make mistakes, but to give you tools how you can improve, how you can avoid these mistakes over time. And not learning from the past, Jason knows that, but is one of the easiest ways to fix, because all you need for that is pen and paper and start writing an investment diary and reviewing your investment diary.
Yeah, and Jason and I, and this is maybe a bit sad, we teach investment teams how to construct a post-mortem session. And we say construct because it's not supposed to be about blame. It's supposed to be about learnings. Mm-hmm. What did we know at the time? What could we have known at the time? What did we learn after the fact? Jason and I got into this wonderful debate with an investor we were working with on a team that they said the thesis was broken. And so we sell when the thesis is broken. And we asked, well, how do you know the thesis was right in the first place? And that investor could not physically hear that question that we asked. That maybe the thesis was wrong and the stock did exactly what it should have done. It couldn't even blow their mind because they were unwilling to acknowledge that. Pen and paper is a beautiful thing.
Another version of that too, that we've also encountered, Michael, is the person who considers the fact that the security has gone up is a victory, but if it goes up for the wrong reasons, it's still an error in judgment. And only by doing a postmortem, even for your investment wins, can you learn from that.
No, I agree. And the most extreme third kind of version of that is when you forget to sell when your thesis is broken, whatever that thesis was to begin with. Because I started my career 20 years ago, roughly. And one of the first things that I noticed, and it was in Switzerland back then, I lived in Switzerland for 21 years. And I had clients who had Swiss Air stocks in their portfolio. Now that was about 2 years after these stocks became worthless because Swiss Air was grounded and eventually filed for not Chapter 11, but Chapter 13 bankruptcy. So they don't exist anymore. But 2 years later, one of our clients still had those shares in his portfolio valued at zero. And I was just asking naively, well, so can we just kind of book it out of your portfolio now? Because that's certainly not going to be worth anything anymore. And he just kind of became incredibly emotional. It was a classic situation where this person would not be willing to even contemplate this stock. Even though it was there in the portfolio every day to see, he could not even see it there anymore.
It's not a loss if you don't sell at a loss. Come on.
It'll come back. It'll come back around. So JK, what's another one of the 7 mistakes?
The other one, I think that's a bit counterintuitive, is I mentioned one of the most common one that is often discussed is being too active, trading too much, and being too short-term oriented. But I also think that you can be too long-term oriented, to the point where I typically ask investors, so are you a long-term investor or are you just stubborn? And it's the classic situation where you see that at the moment, and I'm pretty sure now that I talk about it this way, value will start rallying for the next 10 years. But value investors, and full disclosure, I started my career as a value investor. Still am very fond of value as an investment style. But
you've had a couple of good months. Come on, man.
Yeah, it's February and December, November and December were great. But
so now you become a momentum investor then intentionally, because value is now going to keep going.
Well, let's hope so. But let's be honest, value has not worked for the last decade and longer, depending on where you look at it. And there are plenty of reasons that one can try to come up with as a thesis why value is broken. Nobody really knows is my honest answer. But the question is there a point when you've underperformed so much that you basically have reached a point that in order just to get back to break even versus, I don't know where you invested originally or to just kind of make up for your investment goal of whatever your return goal is or whatever your financial goals are, that you can't realistically achieve that goal anymore. And then
I've worked with a manager like that.
I show an anonymized example of a manager like that in the book, of somebody who's done really well for a long time and then has kept underperforming, and has underperformed with a strict value style for so long that by now the S&P 500 would have to drop by about 90%, 90, in order for him to break even with the S&P 500 again. And so that's a situation where, like, yeah, you might be a long-term investor, but if the long-term is 100 years, forget about it.
Waiting for the next Black Plague. Oh, wait.
And you know what's so interesting in what you just said? Also, the dollars matter. It's not just the investment performance, because what we know the tendency is people invest after a spate of good or strong performance.
Yeah.
And then they don't sell until there's been underperformance. So the manager I worked with, who was a deep value manager, and it's a different person than you're talking about in the book. And I asked him, I said, so let's say you're right and it comes roaring back and you ultimately can declare victory. Here's what I'd like to know is how many investors that you ever actually had, how many actually made a profit with you?
Yeah.
He did not like me. This manager did not like me.
Yeah.
Ultimately, it was really interesting. The CEO fired this CIO before I really dug in and then worked with his team that was remaining after he was gone.
So
it was amazing. He disregarded his investors.
Well, in a sense, what you're just saying there, Michael, is your fiduciary duty that you have as an investment manager towards your client is not just to create the highest returns, but to make sure that your investors are able to capture these returns. And if they are just kind of frustrated and jump off and sell their holdings before you realize those returns, you have not fulfilled your fiduciary duty in a sense.
Absolutely right. And it's the cult of ease that I think that exists in the industry. I'm not going to go anti-fiduciary, although that may exist, is the ease of talking about investment performance because it's standardized versus talking about investor dollars, which is far from standardized. But investor dollars are what matters. And that's why more and more people, part of the reason, are turning to index funds because they just don't want to think about this anymore.
Yeah, agreed.
So Joachim, that's diagnosis, right? So what's your prescription for how to solve this problem? Or to address it, if not solve?
Okay, so all the value investors in the audience, please buckle up now. And if you have heart medication or a weak heart, what I'm going to say now is going to shock you. Please learn from traders. That's what I did. I learned to use one technique that every trader and every short-term investor knows by heart, which is stop loss. Exactly. It's like for a value investor.
I love it. I love it. Thank you for saying that out loud.
Sneak preview, that factors in Michael's and my work indirectly, being a little obscure, but this is close to one of our recommendations with teams we work with.
No, I completely agree. I mean, even if you're a value investor and a deep value investor, you need to secure your investments in such a way that you don't get into a hole that you can't climb out of. And the only way that I know to do that is a stop loss. And when I talk about stop losses, I'm not talking about a mental stop loss where you just go like, okay, if the stock is down 20%, I'm going to sell, but a hard automatic stop loss that overrides your emotions and your incredible capability of finding reasons why the thesis is not broken yet. I first, literally in my career, I first tried it with theoretical or mental stop losses. And I have a traumatic experience. I will never forget that phone call where one of my clients calls me and said, like, you said when we're down, in this case, it was 15% for a specific investment. When we're down 15%, we're going to sell. And it was one of those situations where you go like, yeah, but it's going to recover very quickly. And I just spent half an hour telling my client why what I told him a month before wasn't a good idea and why you should just stay in there. And of course, what happened, that thing went down and down and down and down and down. My client was not happy with me, not at all.
Well, I will point out that one, yes, stop losses. And as a PM, I would like to think that I did not use stop losses and probably held on too long. So I'm guilty of some of Joachim's 7 mistakes. But I did have an understanding that once something declines, and my stop loss tend to be about 20-25% mental one. And I was pretty disciplined about it. But underneath that was a theory that companies have a constituency that invests in them, and that when they're selling en masse, the circumstances which have led to the buy and the purchase on the other side are very different than the sellers. There's a big decline requires a very big difference of opinion, hence the decline in the price. It's a whole new constituents of shareholders that have rotated in there, a whole different constituents of mindsets. So once it's down, it's been my experience as an investor, it takes a long time for something to recover and go back up, because you need to attract new shareholders and the word has to get out. And those who were wounded in it, who were previous lovers of the stock, the company has to find new people just like that who are willing to bid up shares. And that's a tough thing. And it was my experience, once something declined 20-25%, it could be 2 to 3 years until you saw any sort of return to break even. And that's just the underlying reality. So if stop loss offends your fundamental sense because there's no theory under it and just sell arbitrarily, and which, by the way, I highly recommend you do just sell arbitrarily, because it's a strong indication that you screwed up. But if you need a theory, it's that the shareholder base is completely changed and they have different things they're looking at.
And
So
going back to the original topic of geopolitics, where I mentioned, if it's a sentiment-driven thing and it just changes your risk premia, then it will recover very quickly. But if it's a fundamental thing, then it will not recover very quickly. And my classic example, because I'm very interested in ESG investing, which is obviously much bigger in Europe, as you know, than it is in the US. And last year in the summer, we had a fast fashion company here in the UK, which was an absolute stock market darling, went from 1 billion market cap to 5 billion market cap within like 4 years or something like that. And they produce fast fashion, sell it online only, perfect business model for a pandemic. And in July, news reports came out that they basically had modern day slave factories in England, not in somewhere in Bangladesh or India, but in Leicester in North England. Share price dropped 25% in 2 days, and it still hasn't recovered a bit. Nothing. That's a permanent shift in investor base, because the investors who bought into that stock for the reason that it's a young audience, high growth, etc., now see that there's a fundamental problem with their business model and with the way they make money. And that changes everything. And so now, if you go into that stock now, you have to be very patient, because it takes years for them to recover, because they will effectively have to change their entire supply chain.
Yeah.
It's so interesting we've gone down this path. I'll just say, yes, I call that a mechanistic sell discipline. And if you really want to offend professional active investment managers, suggest they do this. They detest, I think that would be the proper word. Jason, is that a fair word to use? They detest mechanistic.
They absolutely do, because it somehow reads as they don't know what they're doing.
So we have designed, I won't give it away here, but we have designed a way around mechanistic that behaves a lot like a mechanistic, but it allows them to save face.
Yeah, and Michael, you and I have, to put a little bit of meat on the bones, we've worked with several clients where if we do an analysis of, had you sold with an arbitrary stop loss of 10%, 15%, this is the additional basis points added just by holding the cash. In other words, losses avoided. And one manager in particular, who shall remain anonymous,
But was a value manager.
It was a value manager. Yeah. And they had a high proportion of securities in their portfolio that had fallen greater than 50%, 50, not 15, 50. And they had continued to hold. I don't know why. But we showed that, Michael, I can't remember the numbers, like 1,800 basis points. They would have been better served had they just had a stop loss and held the cash. And had they bought an index, say they didn't know what to buy it, and they bought the index of their particular style box and ridden it, they would have been up. It was the difference between being in the bottom quartile and like in the top third, if I remember correctly. It was ridiculous.
Over a 4-year period. Yeah. It was just dramatic. And when we showed them the data, and we just took the data and ran simple, and we did it at different levels, minus 15, minus 20, minus 25, et cetera, and showed them the data, the PM, I thought the top of his head was going to blow off.
It did.
And I don't mean at us, but at his team, because the team was not coming to him and saying, sell this now, let's dump it, let's move on. And he could actually recognize, that one there, I can't tell you how many conversations where the analyst has rationalized, just be patient, just be patient.
And here's something that I noticed when I talked to both professional asset managers, fund managers, as well as retail investors, is a lot of time when you talk to them about mechanistic sell rules, the first argument against it is, so what about if that stock turns around tomorrow and I miss all the upside? Which is why I also write in the book about for every sell rule, you also should have a buy rule.
Yes.
You should have a rule, a mechanistic rule that if you sold that and you're still convinced this is a great investment, this is a good stock to own, then also have a mechanistic rule in place when you decide to go back inside again. Because then you at least can minimize the risk of missing out on, Amazon went down 80% plus in 2000 to 2001. And if you had just a stop loss in place and never looked at Amazon again, you would have probably missed out on one of the greatest stocks of the last 20 years.
So I would like to truncate this discussion and summarize, and then I have one question I want to ask you, and then we have a question that's come in the comments, but I want to give our audience a chance to ask JK questions because he deserves to have that floor. The book is excellent. It covers mistakes all of us have made, and it's not just diagnosis. He does have a helpful prescription for how to address some of these things.
Both books are excellent.
Yes, yeah.
And before we go to
politics book, but I trust.
I'm sorry, guys. Everything I do is excellent.
Well, you are my first daily read.
Well, that's because he comes in at 3 a.m. because
exactly.
Are you saying he has an advantage, Jason? All right. And then I won't get into any specifics, but we will have a paper out sometime Q1 together on stakeholder capitalism. I won't go any more specific, but we've actually teamed up and written a paper.
So a good one at that.
I think so.
No, I talked over that. What did you say, JK?
And a good one, an excellent one at that,
Of course, yet again, continuing the trend of excellence.
Questions from the audience.
No. Before that, I had one question I wanted to ask JK that I find, because I think, Michael, you and I talk about one of the hardest things to do well in the investment business is to read the news and extract signal from that. Joachim, you and I have talked about this on a couple of occasions. Talk to us about some of the things that you pay attention to as you read the news. I know you have some techniques for how you try and extract signal from noise.
Yeah, so on the one hand, one thing that I do when I read newspapers or web pages these days on news, when it comes to politics, I tend to always try to read one on the left side of the political spectrum and one on the right side of the political spectrum, because both sides are biased. There is no advantage to reading one or the other. And if you read one from the left and one from the right. Obviously not the lunatic left and not the lunatic right, but something that is still credible. So in my case, it is basically the New York Times and the Wall Street Journal. So that's an example.
That's your left and right?
Yeah.
I know. Sorry, guys. All right,
hold on.
In the UK, I read the Times of London and the Guardian.
Understood.
All right. If New York Times and Wall Street Journal, I will say good if you're only reading editorial page.
Yeah. Yeah.
If you're reading other content, no.
Yeah. So that's one thing, to get that to kind of balance out the different views of the world. Then I have curated a set of people that I consider independent thinkers that have free blogs or newsletters that I follow. It tends to be the case in my experience that those independent guys are better than the guys from company XYZ. Even though I'm a sell-side guy now myself, but it's independent thinkers who don't kind of go with the mainstream, because that's where I get a lot of the good investment ideas from. And I'll be happy to share. One of them is called a certain guy called Jason Voss. I don't know if you've heard him, but he has some good ideas about behavioral finance from time to time. So he's worthwhile reading. Then also some of the more popular guys like Pragmatic Capitalism that you might have heard of, or The Philosophical Investor. It's a blog that I like to read, for example, in that perspective. And when it comes to financial stuff, it really is a situation of me trying to stay away from the daily financial news. Again, just to avoid trading noise. I'm not a fan of Nasser Nicholas Taleb, but he said one thing that is, I think, really, really important. If something important happens in the world, you can be sure that some people will approach you and ask you for it. And so you don't really have to read the news on a constant basis, because you will know if something important happened.
That is an interesting idea. When I retired from the business back in 2005, I went through a news reading cleanse. I did not read any news for 2 months. Hurricane Katrina in the States happened, and I knew it was important because I was at my martial arts dojo and people were talking about the hurricane, and I said, what hurricane are you talking about? And they were aghast that I had no idea, but that was clearly an important news story because it was being talked about more publicly.
I mean, if you want to know what kind of a nerd I am, I don't have a TV, zero, and I am not on Facebook. That already is a news cleanse. I mean, that's like clean living.
I'm only a half nerd.
Half nerd. So let's turn it over to folks. Alam, I don't know if that answered your question. JK's referencing some folks to read, places to go. We have a question from Ian McKinnon. What about selling winners? Anybody else, feel free to either use the chat function or turn your mics on and ask JK. But Ian, you're on. Or your question is on. What about selling winners?
Thanks. Well, I mean, we talked a lot about stop losses and selling losers, but I think often you see portfolio managers hanging on to winners too long. And I mean, things evolve, and certainly you're going to do your analysis and you're going to be staying on top of your investments. But is there a psychology involved with selling winners as well, or mistakes that investors make?
Yes, and I use stop losses to sell winners as well. So first of all, one of the things that we all know, if we're taxable investors, let your winners run, because you don't want to realize those capital gains too soon. And the way to do that is to just kind of regularly adjust your stop losses. So one of the things that I do in my own portfolio is that every year when I review my portfolio, I pull stop losses higher. If I have an investment that has gone up 20%, I can pull the stop loss 20% higher, and I still have the same stop loss, but I lock in those 20% gains in a sense.
Michael, some of us call that a trailing stop loss.
Michael, say that again. Sorry.
Some of us call that a trailing stop loss. And the question coming from Ian, I'm not going to debate this with Ian, my friend Ian. Ian's a bond manager. So I find that question fascinating coming from Ian.
Well, I'll add a little bit of wisdom for the non-fixed income folks on today's call. And we discussed this, Michael and I, in one of our previous podcasts on most misunderstood investing concepts. And we had a whole discussion on fair value. We laugh at value investors who are very concerned about a margin of safety on the buy side of their security, meaning, hey, I want at least a 15% margin of safety in case I valued something and screwed up, but they're not willing to acknowledge the other side of the distribution, the right side of the distribution, which is I should let it run above my fair value estimate as well, because I may have screwed up on that side in estimating the value as well. And too frequently, I've worked with teams over the years, Michael, I know you have too, where the fair value becomes the target price. And we hate the term target price because it implies that there's a decision to be made when the target is achieved, and they're used interchangeably. They're not the same thing. But not only that, you have to, one way to let your winners run is to acknowledge your margin of safety on the right side of the distribution too.
And the funny thing is, the same people will then show a chart where the share price fluctuates above and below the fair value. And if your fair value is your target price, you're basically giving up all the fluctuations of Mr. Market and his irrationality above the fair value.
It drives me crazy. It's one of my true pet peeves. I'm a peevish sort of guy, but this is perhaps one of my favorite pets to stroke.
So we have a nerd, a half nerd, and a peevish sort of guy.
Yeah.
Speaking on this call.
Exactly. Any additional questions for Joachim?
I got a question.
Yeah.
I'm from New England, and we're big sports fans up here. And there's a very simple phrase that may or may not have applicability to the 7 mistakes discussion. To what degree, JK, would you utilize the phrase defense wins championships?
It's, I would say, at least 90% correct, if not 100% correct. If you look at the portfolio managers, or if I look at the portfolio managers and investors that I have met that have had a long and successful career of 20, 30 years and longer, most of them have had that successful career because they reduced the downside. It's not because they were able to pick the winners. It is the same thing, you know, that Charlie Ellis book about winning the loser's game with the tennis analogy. For most of us, winning a match of tennis comes down to making fewer mistakes than the guy on the other side of the field.
Yeah, and Brian, for what it's worth, I am full agree. And by the way, we have surveyors at our house today. Of course, they were supposed to have come yesterday, and I see them behind there with the surveying stake. Nice timing, gents. But in any case, welcome to the Zoom world. I have written that in my portfolio management days, my big goal was to not make mistakes. And my biggest successful year, I wrote my shareholder letter that this year I didn't make any mistakes. And by mistakes, that doesn't mean that things didn't go down. It meant that I understood why they had gone down. I had properly assessed and understood the name. It happened to be that risks I identified had materialized, but nonetheless, I understood what was happening. That's another way of saying the defense thing. And then the other thing I'll point out, the entire insurance industry is based on the fact that risks tend to repeat themselves. And risks are much more predictable than are things that would generate return and opportunity. By definition, if the company's going to grow, it has to find new customers, new products, haven't been invented yet. Very hard to discount, and that, but it's very easy to discount the risks, and they tend to repeat themselves over and over again. And that again would say, let's emphasize an understanding of the risks.
Mm-hmm.
Companies can go to zero. So there's a lower bound, but they can go much, much bigger than that. So if you follow that natural order, because that is a natural order, then truncating the downside, whether it be mechanistic, right? Truncating the downside over time will compound the dollars in the portfolio at a higher level. So it comes back to dollars again, and you will reward your shareholders brilliantly.
Brian, you have any follow-up on that, or are there any other questions?
Well, actually, I have a plug follow-up, and it's not about me. It's about Michael. He just published an article, And it's a very, very humble title. Everything you need to know about investing. But here's the kicker. It really is.
Go big or go home.
Everything you need to know about investing. And if anybody wants it, I'll make sure it gets to you. Just let me know. It was published in the Investment and Wealth Monitor that just came out last week. And it fits nicely alongside what JK has been talking about, and you, Jason, and you, Michael, today, in terms of the 7 mistakes. But really, it's a guidebook on how to really deal with all those issues and address it. That sits nicely alongside the guidelines that I think are in JK's book. I haven't read it yet, but I'm looking forward to it.
Yeah, it's well worth the read.
I think the two together are a great combination.
Woohoo! Thanks, Brian.
Thank you.
Sure.
Anybody else have a question for Joachim?
Podcasts. Are there any podcasts that you like? And when you're looking for blogs, outside the current ones that you're reading, are there any criteria that they have to meet, or do you just are you just curious about everything?
So when it comes to podcasts, I have to admit, I'm a big podcast fan. I listen to podcasts on the way to work and on the way back.
Wait, you go to work? I thought you were in lockdown.
No, not anymore. At the moment, not. Sorry, it's 2020 not. But normally, I've got a little bit more than an hour to get to work, and
it's a long walk from his bedroom into the whatever room is.
Yeah. The end result is that the list of unlistened to podcasts has become very, very long in my case. However, when it comes to podcasts, I almost exclusively listen to podcasts about history or politics. If you want to have recommendations, one of my favorite ones is called Talking Politics. It's 2 Cambridge politics professors talking about politics. Not just about European politics, but also about the US. And it's brilliant because it is so boring. It is really competent people talking to each other. So that's one that I can highly, highly recommend. I don't typically listen to finance podcasts, strangely enough. That is something that I consume reading. So I read newsletters, as I said, I read blogs. Which blogs do I choose? I try out a lot of blogs. I try out a lot of newsletters. And if the quality is such that it surprises me on a weekly or monthly basis, that it is somebody who has thought about things in a way that I haven't thought about, and that creates kind of a different viewpoint in my work, then I stay hooked. Then I stay with them. When I had a beer too many at the bar, I tend to say there are only 3 ways how you can make money. And that is, you can be faster than everybody else, you can be better than anybody else, meaning having the better forecasts or whatever, or you can be different, doing what nobody else does. And I know that I can't be faster than anybody else, not in the world of high frequency trading and automated trading and whatnot. Being better is what everybody does, and there are millions of really smart investors out there, and I don't pretend to be smarter than everybody else. So I have to be different. I have to look at things in a different way, and that's what I'm trying to find. Other people who write in a different way and have a different perspective that I might agree with or might not agree with. I mean, one of the people that I read that I don't like that much is Jesse Felder, who's incredible. He's a perma bear. He always says the world is going down the drain. Or take Jeremy Grantham of GMO. He probably, in terms of investment perspective, hasn't been too successful, but he has interesting ideas. And even if I disagree with him, he makes me consider my investment thesis and my view of the world.
Well, the interesting thing about Jeremy Grantham is that his writing is usually not so bad. Problem is the people on the inside of the firm who are actually allocating the assets don't follow his writing.
Mm.
You'd have a hard time matching what he publishes and what's in their portfolios. Just saying, it's not getting translated well.
Mm.
we are at the end of our hour. I'm going to call time unless there are any final comments from either JK or Michael. Any final comments, Chance? Yeah, Michael.
Thank you. Happy New Year to you, my friend. Happy New Year to everybody on the call. This was a treat.
Yeah, thank you as well. JK, thanks for joining us. Again, the Geopolitics monograph is free from CFA Institute. The book, 7 Mistakes Every Investor Makes. Our next podcast is going to be the 21st of January. We will see you there. Thanks so much for joining us.
Bye, all.
Bye.
Bye.